Now, as promised, the math-based trading strategy on DOM is related to the Gaussian distribution. Today I'm going to introduce you to the famous trading tool that is called DOM. Watch this video until the end and I'll share a strategy as well if you want to use it. DOM stands for depth of market, or you can find it as the price ladder. My mission is to convince as many traders as possible to use it to finally start their money-making trading career. But without further ado, let's start. Trading is essentially an auction between buyers and sellers, and DOM is the best representation of this bidding war, but in a more readable way to help traders make money easily. Now, I don't know how this session is gonna pan out because today is Thanksgiving, but I'm gonna try my best to explain to you, even with a little trading activity. Now, let's pull up DOM. This interface is called DOM. The asset I'm showing now is S&P 500. Here, we can see the supply and demand columns. These are aggressive market orders, and here you can see the pending or limit orders for each side. To place a market order on DOM, for selling we have to press the empty red box, and for buying the empty blue box. If we want to be on the supply side waiting to be filled, we can choose any price level we want for selling and buying and click once there. Not in the empty box though, because if you remember, the empty boxes are for direct market orders. I know you're probably wondering, what's this here? It's the volume. These are all the market orders executed from the morning until now. Here, in this price level, we can see that they were executed 158 market orders from the demand columns here and were recorded there, not on the supply side. The reason that this bar is blue is because the market orders in this price level were the most for the day so far. Let's do an example. Here, we entered a pending selling order by clicking at that price level, waiting to be filled, and you get out by pressing the X, and the same with buying pending order like that and cancel it the same way. If I want to be aggressive and enter the market, then I need to press here. My market order will be recorded on the white column, and if I want to exit, then I have to buy here. Now I'm selling and immediately bought to cancel. I know that this video is probably not gonna get loads of love because not many people know all these amazing tools or how to trade correctly, but I did it anyway because I really wanted to help you guys to improve. So if you somehow found this video, hit the like and subscribe button for more amazing videos. And now buckle up. This strategy with DOM is gonna have some math into it, and trading mostly makes sense with a mathematical strategy that is backing up our actions in the market. At least for me it does. You might heard of this from school or from the university, but if you didn't, it doesn't really matter because you don't really need to study anything. The Gaussian function looks like this. 70% of the values are lying here in this section, and on the two tails it's 15% on the right and 15% on the left. That's the rule for this distribution. So if we relate this to trading, 70% of market orders are lying on this area here. So when the price arrives to the left tail, then we need to trigger a sell order and target this blue bar here I mentioned earlier that has the most market orders for the day. The same with the right tail. So when the price arrives here, then we have to trigger a buy order and target again the most traded price level of the moment you are trading. Something I forgot before is that because on DOM the Gaussian distribution is vertical, then the left tail that I mentioned is on the top and the right tail that I mentioned is on the bottom. Back to DOM, we can clearly see that the Gaussian distribution is formed. Now, putting everything in practice, we can enter a selling trade and then target here. You can see it moves down slowly, and again, if it arrives to this price level, trigger buy, or you can put a pending order here and target the blue bar again. Lots of profit, guys! A downside of DOM is that many algorithms are reading DOM and they could just sit on the supply, creating false expectations of the market's intentions. For example, a huge pending order could be sitting there, and as soon as it reaches that price level, it automatically disappears so fast. This is called spoofing of the markets. Now I showed you in detail one tool that the best traders are using. So why do you still insisting on using the indicators? It doesn't really make sense. Just stop it. It's not worth your precious time. Focus all your time and energy on learning this instead. Stay tuned to this channel for absolutely free trading knowledge and try the strategy I just mentioned, and let me know in the comments below, or you can comment the next topic you want to see on my channel. Follow for more tips.